Okay, good evening, everybody. Firstly, from Gradidge, myself, and the team, thank you all for making the time to be here tonight. We really do appreciate that you've taken the time out to join us, and I certainly hope that we add value to the time that you've afforded us. So thank you. Congratulations, Munaf. Munaf was quite nervous about today's presentation, and I think we did an excellent job. Just from my side, two things. Firstly, I am recovering from the flu, so I hope my voice will last. Secondly, I think my jacket is in one of three places. It's either in my car, it's at home, or it's on an aeroplane. I'm just not sure exactly where. But when I jumped out the car, I couldn't find my jacket, and I remember being on the phone when I jumped out the car to go to the airport. I'd been on a long phone call, and I can't remember if I actually brought it. So my apologies if I'm a bit uninterested. Okay. So my talk tonight, okay, firstly I've been asked just to give you guys a bit of an update. Thank you. This is all, due to the clients that we have. The businesses, next month will be 18 years old. And I think, we needed to update the slide, but as at the end of 2025, we now have 4.5 billion of client money under management. So the business, it took us 11 years to get to 1 billion of client money. It's taken us a year to grow that. And that's largely thanks to the support that we have from our clients. Our clients continuously refer us, and they keep us on our toes. And they're honest, so we have very robust engagements with our clients. And I think the results have largely been fairly good. Okay. Thank you for staying. So, my talk tonight is around structuring portfolios for the long run. And what we want to do is just give you some insight into how we go about structuring the portfolios and what are some of the things we think about. Now, the reason that structuring is important, and this touches very much on Munaf's presentation, what this slide shows you is what the average investor has earned, the average equity investor in the United States has earned over several periods, 3, 5, 10 years. That's the dark blue bar. And the green bar is what the market delivered over that period. And you'll see that in all instances, most investors, because if that's the average, pretty much half investors are earning below, and most investors are earning less than what the market has delivered. And what this is known as in the industry is the behaviour gap. This is the cost of the decisions that investors make. Okay, essentially, and you see it in industry flows, you see it in client activity. But typically when markets are doing well, lots of money comes in, and when markets start doing poorly, lots of money moves out. So people tend to buy when things are going well, and they tend to pay, buy into the market when things are high, and then they tend to move out when things are not going so well. And as a result, over time, investors earn a lot less than what the market earns. The impact of, if you invested 100,000 30 years ago, the market would have converted that 100,000 to 1.5 million. The average investor at 6.8%, that 100,000 grew to 720,000, less than half. Okay, that's the impact of compounding. Okay, when you compound the 2.8% difference, after 30 years you land up with less than half of what the market actually delivered. So had you just stayed invested through the ups and the downs. So from a long-term perspective, when we put portfolios together, we need to understand that this is the client kind of experience, and this is the sort of behaviors that we may potentially expect along the way. And so what we need to do is then ensure that the portfolios we put together, firstly, are robust, resilient, and they have a higher than likely chance of keeping clients invested. So our starting point, people think that we just choose funds. When you put portfolios together, we just think we choose fund from 91, Ellen Gray and Coronation and Satrix, and then there's your portfolio. Actually, then there's quite a bit of science and art, but there's quite a bit behind the scenes that we do. And the starting point to putting portfolios together is this issue of the central limit theorem. Has anyone heard of the central limit theorem? Okay, this is some of the maths behind long-term portfolio design. Okay, and essentially what the central limit theorem says is that if you take a longer-term view, the longer your observations, the more stable your average becomes over time. So if you look at so most people are sitting this side, but I'll explain it. So the orange line, that orange line, every point on the orange line is a 1-year return. Okay? So every point, every dot on that line represents a 1-year return. And you'll see the range is quite wide. It goes from minus 40 to plus, to almost 50%. There's a positive skew, but it's that's the range. If you then look at the green line, that is where you take your 5-year average return and you plot that. And there you see that consolidates a bit more. So now your range is only minus 15 to positive 30. So you still have the positive skew, because over time the stock market does give you positive returns, but it's a much more stable sort of pattern of returns. And then when you look at the blue line, that's plotting 20-year returns. Okay, and you take the average, and every 20-year average return, you plot that, and you see that it's a much more stable distribution. The first thing you notice is that it's positive. Okay. It's positive. So the average is positive, and there are very few kind of returns below zero. In fact, those few are actually the 20-year periods that ended during the Great Depression. Those 20-year periods are what actually appears underneath there. But over pretty much since 1950, on a rolling 10-year basis, you've had positive returns from the market. So when we design portfolios, what we do is we start off with your long-term expected returns based on what we've seen with a very large set of data. Okay, so that's our starting point. The last point I want to make before I go into the funds is how we see the markets and how we understand markets. And I think this is very important, because a lot of people have a sense that, the market is the JSE. It's this place in Johannesburg, the Johannesburg Stock Exchange, it's the London Stock. That's where the trading kind of happens. But the market itself is what we refer to as a complex adaptive system. And if you understand complex adaptive systems, the various complex adaptive systems, the weather is a complex adaptive system. Traffic is a complex adaptive system. Okay, if you think about traffic, there are many different players. Each player can have an impact on the traffic. Every single player is making decisions independently. There are lots of players. So there's the drivers, there's the pedestrians, there's the weather, there's the condition of the road, You know, in Joburg, if you're driving on a quiet road, the car in front of you can swerve for no reason. And that's because the pothole that's there today was not there yesterday. And that happened to me on the road to the airport yesterday. I drove that road last week, and there was a massive pothole that was not there last week. And luckily, the guy in front of me swerved. So you have this complex adaptive system where you've got lots of moving parts. Oh dear, talk of moving parts. You've got lots of moving parts, and you've got independent parties making decisions. And as a consequence of that, it becomes very difficult to predict outcomes. Okay. Prediction is not what gets you through a complex adaptive system. It's resilience. Okay, so when we build portfolios, we are building portfolios not based on our prediction of what we think the market will do. We build portfolios so that they are robust and that they are resilient. So that if we have a US-Iran war, if we have a president who changes his mind every 10 minutes, who's in charge of that war, that the portfolios that we have are able to withstand what that means for markets. And so when we started putting our portfolios together, the first thing we did was we spent a lot of time on asset allocation. Asset allocation remains the heart and the key driving force behind what we do. The numbers are, I don't think the actual numbers themselves are not important, but you'll see each of those portfolios, so the cautious managed. We said, when we scoped that fund, we have who's the investor that goes into this particular fund? What does this investor need from this particular portfolio? So what does this portfolio have to deliver? And then based on kind of the long-term averages that we pulled from the different asset classes, we were then able to come up with an asset allocation that over time will provide those outcomes more often than not. Okay, so what we do is, if you look at our asset allocation today, and you look at it 2 years from now, and you look at it 2 years ago, the asset allocation will be quite similar. Okay, we're not trying to predict what markets will do, because when you try and predict what markets will do, that's when you start taking a bet that maybe local equities will outperform offshore, or offshore will outperform local. We don't do that. We're not trying to predict, because prediction doesn't work in a complex adaptive system. What we do try and do is build resilience. So our moderate fund, more for investors closer to retirement, so they have a bit of a balance between growth and capital protection. The growth fund, more for younger investors further away from retirement. We have to comply with Regulation 28. So there we have a lot more equity, but the worldwide fund is for those portfolios that don't need to comply with Regulation 28. These are not pension fund investments in our offshore portfolio. And the question is, have we seen the resilience? So what this shows is our quartile ranking, and this was updated to the 31st of March. Okay, so these are, we should get the April numbers out, but I think the 1 month, which was March itself, that was pretty much when the war started, was at the end of Feb into March, and the portfolios actually did show resilience. So each fund, the ranking shows which quartile. So quartiles, your top 25%, second 25, third 25, or fourth 25%. And all 5 quartiles, 4 of them were in the first quartile, so they were quite resilient. They actually delivered pretty decent performances in that month relative to their peers. And our cautious fund, well, it was pretty high up in that second quartile. Over 3 months, so since the start of the year, January, February, and March, again, most of our funds sit in the top quartile. When the war broke out, we didn't kind of get together and say, okay, guys, what do we do now? We didn't look to move the portfolio around. We didn't look to make short-term decisions based on what was happening. Portfolios had been, there was a lot of thought, there was a lot of good thinking behind the construction of the portfolios. We were quite happy to let them fly. And then, we'll get a 5-year track record on the 1st of July. So that's why that only goes up to 3 years. So our funds are currently, we're 1 quarter away from a 5-year track record. So that's on our local funds. We launched our global fund. So when I was here last year, I think it was at Old Mutual that we had our conference, we launched our global fund a month later. Again, we spent pretty much 6 to 9 months putting the asset allocation of the fund together. And how this fund, so this is a dollar-denominated fund. We've domiciled the fund in Mauritius, and the reason we've done that is that from Mauritius we can access a lot more funds than we can access from South Africa. And in doing our research here, what we realize is that in global markets, your active and passive balance looks very different to in South Africa. So in South Africa, we have a lot of managers that actually consistently beat the market. Globally, that's not the case. So what we did is, in our building blocks, we actually weighted that portfolio significantly more to passive. So kind of 35 plus 35, 70% in passive, and only 30% in actively managed portfolios. And one of those funds happens to be a 91 fund. So we've got 3 actively managed funds, one of those managed by 91. And that portfolio, its 1-year return, also it's been, this is a short term, but very encouraging for us is those grey blocks. The dark grey is all your funds in the first quartile, the range of returns. The next block below that, that's your second quartile, third quartile, and fourth quartile. And we've consistently managed to stay between first and second quartile. And again, it's not about prediction. We didn't predict what happened last year. In fact, after our first month, the fund was down almost 10%. Because Trump had a tariff tantrum and all of those things. And we didn't make any decisions based on what was happening over that short term period. We stuck to our guns. And pretty much, I think towards the end of April, that gap's closer to 6% now. And then the last slide is our offshore passive portfolios. Because we've recognized that offshore passive works a lot better than active, it's a lot more robust. We launched passive model portfolios, and these are more for our bigger clients that are a lot more fee sensitive. And so you can see the iShares, iShares, iShares. So just giving you a sense of how we execute. So asset allocation comes through in that you've got your bonds, equity, cash, and infrastructure. But on the equity side, what we decided to do was downweight the fairly expensive S&P 500, and we upweighted the much cheaper S&P 400. So those are US mid-cap stocks. and small cap stocks. And what we saw over the years, actually, those stocks outperformed. It wasn't a prediction. It was based on the fact that the relative valuation was just completely out of whack. And so when that happens, when you see that it's more than a standard deviation away from its average, that's when you can confidently say, okay, we can have a bit more invested in that part of the market. But the asset allocation has remained pretty robust. Our moderate fund actual performance, 13.7% in its first year. Its peers did 10%, and the growth fund did 17.5%, and its peers did 14.3%. So we're quite happy with the outcome of the performances that the models have delivered. But I think it's important to understand that this is not based on prediction. The philosophy that we've implemented, it's been the philosophy that we apply across all our funds. So in conclusion, long-term investing is less about prediction. It's more about structure, discipline, and time in the market. Okay, so we both have a role to play, us as your advisor, but you as a client as well. When things get uneasy, as Munaf said, which part of the brain is taking over at that point. Maybe use us as an accountability partner, not as an advisor at that point. Asset allocation remains the core decision. That's ultimately what drives resilience, income sustainability, and growth. Okay, it's not prediction. Diversification is intentional. So across geographies, across asset classes, managers, and different implementation styles. So yes, we have multi-asset funds in South Africa, multi-asset funds in offshore, but we don't apply the same philosophies in those funds because we see that things will work slightly differently, and we are able to apply our overarching philosophy in those different contexts. And then finally, the real edge is behavioral. The market gave you 9.6%. It's client behaviors that takes it down to 6.8%. Okay, so that's the real edge. We'll do our best. We'll squeeze out costs wherever we can. I see some of the fund managers in the room don't like that, and we try and squeeze out costs, but we keep doing that. But the portfolios we design, it helps when clients stay invested, even through the more testing times. So I hope that gives you a sense of how we manage portfolios and what we do. It's not just about choosing managers. It's not about predicting markets. It's about having a pretty robust philosophy and implementing that with discipline and with a long-term perspective. So thank you very much on behalf of everybody at GMI. We appreciate your time.